We do have the Imperial story. We'll start our results service on Power Lunch today with Imperial. They came out with a really good set of numbers. Earlier, my colleague Alicia Seckham spoke to the CEO, that's Hubert Brody. Here's that conversation.
Yes, we continue to have good steady momentum. But some of the difficulties that we had in the 6 months was industrial action that affected us in South Africa, the transport workers strike in September and October. And then industrial action in Korea affected us because the supply of vehicles and the mix of vehicles which we could retail was affected. And then also on the negative side, generally the industrial and manufacturing environment in South Africa is very subdued, and therefore our local logistics businesses, didn't have much volume increases to base their business on. But the momentum comes through the portfolio that we have in the group, and the good portfolio effect. And this half, you would see that our retail and our consumer-orientated businesses really performed well. The import and distribution of vehicles, particularly the maintenance and repairs and the after-sales part of the vehicle business, was very strong. And there's still some good momentum in the new car sales. And then the financial services which we sell through a business which we call Liquid Capital, and also through the Regent Insurance Group. So all of those were strong and kept the balance, and in fact gave us the good outcome of a 15% core earnings growth.
So you've got those two divisions cushioning things for now. Let's take a look at that auto unit specifically, because it's the debt-led consumer spending that's lifted that division of the business and worked, as you said, to offset a weak logistic market. How sustainable a scenario is that right now, and how concerned are you at this stage about the health of the consumer to continue driving that balancing effect?
We believe the fundamentals for the motor vehicle market and sales of new vehicles is still good, to have a solid and reasonably predictable growth in the motor vehicle market. We're not yet at the peak that we were in car sales in 2006, and at this stage it's based on far healthier personal debt levels than it was at the time. Debt servicing levels of consumers are actually at very manageable levels at the moment. And then the penetration of new vehicles in the total South African market compared to the developed world, and you've always got there's a lot of upside as a market development, as GDP in a country grows, for more vehicle sales. So we believe there's reasonably good and predictable growth in the car market, and there's still quite a bit of momentum. And finally, vehicle finance from the banks. It's an area which the banks have done well in the last couple of years, and they've got good appetite to still finance this category of asset.
Of course, that performance there standing in contrast to your car rentals and your tourism business, and those are two segments of the business that's been facing challenges for a while now. I mean, take us through that, because on that front, operating profit reduced by 13% as costs rose ahead of revenue improvement, and that seems to be a little bit of an Achilles heel right now.
Yes, we are disappointed in that performance. It is a highly competitive market, and it is a market where on the car rental side there were actually very low arrivals, both domestic travel growth, in fact negative domestic travel growth over the 6 months which we're reporting on, and also in and some of the arrivals which we had from international travelers over our 6 months which we report on, and therefore that subdued our performance. And yes, very competitive, and there was no top line growth for, as I explained, but costs continue growing. Accident rates was heavy, and then unfortunately quite severe weather events in the late parts of this half affected us well and took a lot of our vehicles off the road and into repair shops.
You talked of that the tourism arrival rate that we're seeing in South Africa now. Is it more telling of South Africa and its status as a tourism destination in your books, or more telling of the global economic scenario that we're facing?
No, I think it has everything to do with the global economic scenario, where there's difficulties in Europe, and the main source of travellers to South Africa are travellers from Europe, from the UK, from France, and particularly from Germany. And those are naturally under pressure for the economic reasons there. That has affected the arrivals, and it has also affected the tour groups that come to South Africa, and the volumes in that has affected us specifically in the tourism business.
You've highlighted the challenges on the logistics front, and you know, it's been under pressure, as you say, both at your home base and in your international markets as well. Let's take a look at margin expansion here, because that seems to be having a tough time of it across the divisions, and the decline mainly caused by you know, the supply disruptions, the impact on your sales mix. It's also having an impact within the positive in your financial results, and that in the financial services industry, in that your underwriting margin declined as well. So talk us through the kind of pressures you're seeing on that front.
On our margins. Look, the pressure that we have on the margins, definitely the industrial action that has affected us on the margins. Certainly if you are virtually standing still for a couple of weeks in the logistics business, that has a significant effect. So that's had a notable effect on the margins. And then the mix of vehicles which we could distribute because of the disruptions was affected as well, and we had more supply of vehicles on the affordable level where pricing is very, very competitive. We're looking at improving our margins in the financial services business. It has actually improved nicely across that business, although the underwriting portion of financial services was affected now again because of the weather events, and insurers at the moment, all short-term insurers, have been quite significantly affected by what happened there.
Let's take a look at the balance sheet. It remains healthy, you say, with net debt equity ratio sitting at 52%. What's a level that's considered risky for your business? Because some companies have been extremely conservative when it comes to gearing, and that on account of the challenging economic environment.
Yes, it's clear that our cash flows are very strong. Our cash flow generated by operations were more than doubled over this half year. So we can certainly sustain a higher gearing. We can sustain a gearing of between 60 and 80%, and even if we maybe make a large acquisition and we go slightly over the 80% for a while, that's fine, because of our cash flows we will move back into that bracket. So we feel there's significant capacity now for acquisitions, for organic growth, and for growing the business in general. You
have been recently very acquisitive. Talk us through that strategy moving forward, because like you say, you're positioned to take advantage of any attractive growth and acquisition opportunities as they arise. Is there anything in particular that's glaring on your radar screen?
Yes, we're looking at African acquisitions. It's particularly an important area for us, and effective now in January, so not yet in the numbers, but effective now, is the acquisition of RTT Health Sciences, which we'll rename Imperial Health Sciences, which will be give us a good distribution footprint in Africa, and giving us a physical presence and distribution centers in places like Ghana, Nigeria, Kenya and Malawi and so on. And off that base, through other acquisitions, we hope to distribute more pharmaceutical products, but also consumer logistics products, because consumer logistics is our key focus in our African expansion. And then in Europe, maybe the markets are difficult there, but this is often the opportunity to make the right acquisitions. So we're on the outlook for good acquisitions in Europe that can augment our good mix that we already have there.
When it comes to Africa specifically and your operations within that, I mean, we've seen operating profit generated in Africa, outside South Africa, rising by 36%. What kind of targets have you set in terms of the kind of contribution the rest of Africa is going to be making to your business moving forward?
Yes, in fact, our operating profit over the last 2 years out of Africa has actually doubled. And if we can double that again in the next 2, let's say 3 years, that would be a good target to go for, and we think the appropriate opportunity.
That was Hubert Brody, the CEO of Imperial, on the occasion of that company's results released earlier today.